Okay, so I'm going to just quickly wrap up all of the questions as speedily as I can, because there's obviously quite a bit of them. And you guys, I'll take some more questions just now, but just let me work through some of these. So Sivakaran, you've asked one of the first people, one of your questions was about the expansion and Judas swing, power 3 AMD. So all three of those things, power of 3, Judas swing, AMD, which is accumulation, manipulation, distribution. What is Judas swing? So basically it's the same thing, it's just a different name that we call it. So whether you say it's a Judas swing, whether you say it's a power 3 or an AMD, we are saying that that Judas swing is the power of 3 or it is the AMD. It's an interchangeable name that we associate to a particular market move, and that particular market move looks something like this. So during, say, Asian session, before price starts to move, something like whatever gold or whatever GU or whatever you're trading, you're going to find something like this where price trades inside of a range over here. And then obviously at the top here is going to be some liquidity, and below down here is going to be some liquidity. So sort of price is trapped inside of this trading range for the Asian session. So we refer to it as the power of 3 or as the Judas swing or as AMD. So price is accumulating, and then obviously we are anticipating that once price trades outside of the range in a particular direction over here, that we are saying that that move is going to be manipulation over here. So accumulation starts over here where price accumulates. Basically, we refer to accumulation as sort of like consolidation or trading sideways. So that's where the accumulation parts, because it's different from when we refer to accumulation as in SMT accumulation. We are referring to accumulation as consolidation here. Okay. So it's not the same as an accumulation in terms of accumulation on SMT. There's a big difference in terms of accumulation for SMT and accumulation, manipulation, and distribution. Accumulation is consolidation. Okay, they call it that. Okay, ICT people. Okay, so we are accumulating, price trading sideways, consolidating, and then this move over here would be potentially some kind of manipulation over here. Okay, and then after the accumulation comes the manipulation, and then after the manipulation comes the actual distribution over here. And the purpose of this is to trap the traders over here who went short, and also the traders who went long. Okay, the reason for that is obviously when price is trading in a consolidation like this, there's liquidity for the buy side liquidity and liquidity for the sell side liquidity, buy stops and sell stops on both ends of the spectrum. And they are not willing participants to wait for the London session or possibly even know how to identify manipulation in the market. And then they are trapped because they believe that price is going higher over here, only to manipulate and activate the buy side liquidity or the buy stops because they think it's breaking out. And at the same time, it confluences to the average Joe that the price is actually going higher, and then they buy more. So more sell side liquidity accumulates here as price over here moves higher, because they see now, oh well, I was right, I'm in a buy, so this move is going higher, so price is breaking out. And then in actual fact, what's actually happening is that price is manipulating, taking the buy side liquidity or the buy stops over here, and then reversing to go lower over here. And then obviously, both ends of the spectrum is knocked out because the buyers got knocked out for price moving down over here. And obviously anyone that was in a sell got knocked out because price. And then all of a sudden, like, they confused now because it just went up and now it just went down. So what the hell is actually happening over here? And then that's where they get confused by the manipulation part, because many people don't understand how to read manipulation. So one of the key factors of how I've taught most of us here is the fact that we can identify what manipulation is. Because if we can identify what manipulation is based on any time frame, whether it be like 1 minute or 1 hour or 1 month, the same rule applies, is that this model that we see here, this power of 3, or this AMD, or whatever we want to call it, Judas swing, this is in fact manipulation taking place, and identifying manipulation is really the key takeaway of understanding what the London structure will likely do. And obviously this model applies to a 1 minute, this model applies to a 5 minute, a 15 minute, a 1 hour, a 4 hour, because all time frames are fractals of each other. So this model that we see here, this is a very rough model, but it really sometimes looks a bit different, but it's really the same thing. This model is applicable to all time frames. Okay, so you could see this on a daily chart. So let's just see here if we can see something like this on a daily, or something on a higher time frame maybe. So sort of something like this, where price is stuck in this range over here. It accumulates, okay, trades sort of sideways, doesn't really break out the range, then it dips down below over here. And when it dips down below, obviously it activates the sell stops, because they believe that it's broken this range over here, and then boom, price reverses over there. Okay, and then also it's really sort of the same thing over here. We have something on the higher time frame of this 4 hours, sort of price is trading in this range. It does a little peep out over here of this range, and then this little range over here, that's about 70 pips, so it's trading higher, and then boom, it drops. Okay, now it doesn't take both ends of the spectrum here, because you can see it trades up 70 pips, and then from trading 70 pips, boom, it drops 100 pips. So obviously it's hunting buyers and sellers and their liquidity pools over there when it does something like that. Okay, and generally, if we think about what CERR stands for, which is consolidation, expansion, retracement, and reversal, we must understand that that model that applies to whatever the market structure looks like, I hate that word, but most of the people use it, that model applies throughout. Consolidation, price expands, and then when it's expanded, is it going to retrace or is it going to reverse from the expansion? Okay, and that model applies to AMD, power of 3, Judas swing. So that is what the Judas swing is, Tivakaran. Hopefully that answered your question. So basically you asked me, what is Judas swing? So Judas swing is power of 3 AMD, and hopefully I explained quite a bit there about what power of 3 is. It really just comes down to you looking for it in the marketplace, and you can see it pretty much every day, especially even on like a lower time frame. So like now, here's a consolidation, and then obviously there'd be some kind of consolidation. It's about 45 minutes away from the London, so price is consolidating over here. And then when it's consolidated, there's going to be some kind of break of this range over here, because there'd be liquidity resting up top over here, liquidity resting at the bottom over here, and then obviously in the middle, like there's little smaller liquidity pools like over there and over here. But really the bigger part of the range, which is this high and this low, there's obviously resting buy side and sell side liquidity of this range. So this is a perfect example of what that could look like. So what we could expect or anticipate is that this is a consolidation or an accumulation, and then price will manipulate, possibly maybe move down to activate sell side, and they think it's going to go lower, and then maybe reverse and go higher, or go higher, and then everyone thinks it's now going to buy, and then when it gets here, basically reverse. And the only way you're going to identify or be able to read that manipulation is through using tools like an SMT, because it's all very well we say, oh well, it's accumulating, it's going to manipulate. Well, how do we know it's going to manipulate? And you're going to use your SMT to tell you it's going to manipulate. And this happens all the time. I mean, this happens, I know you like to trade gold, so like it happens even on gold. So price accumulates. Here we can see it's sort of just trading inside of this range over here. That was the Asia session. So there, just before the Asia started, we could see it made sort of a high, made a low, and then it's sort of trading inside of this range. And then it's really the same thing. Price is going to accumulate, and then it's going to manipulate, and then distribute. So, maybe the manipulation comes down, takes the low, and then moves higher for this higher time frame liquidity pools up top here, like on the daily and things. So there's this high here, there's this high here. We are also inside of a weekly order block over here, and also there's still this monthly SIBI over here sitting on the on gold. So the bias is still sell even though it has been trading higher, like on the daily and things, so there'd be short-term buyers over here, the overall trend is bearish. So any sort of high that gets taken is a turtle soup and a premium, which is a highly reactive area. So I would say there's still this draw on liquidity for price to go higher over here, and then when it gets higher, possibly look for some kind of SMT and then go lower, something like that on gold. That's what I would anticipate. So hopefully that answers your question, Tivakaran. And then you asked me another question here. What is the linkage between news and IPTA? So I'm not really quite sure what you mean by this question. IPTA is the interbank price delivery algorithm. So I don't know if you've ever watched some larger news event that unfolds. And generally what you'll find with these larger news events is there's generally could be 15 minutes before, could be an hour before, 5 minutes before. There's generally some kind of SMT that takes place before this big news event. I'm not talking about, medium impact news. I'm talking about something that would, create a lot of volatility. High impact news events, and SMT is one of the leading indicators sorry, to tell us which direction the news will want to go. And you can actually use that maybe today, because I think today NFP, it's the first Friday of the month. So, what you could do, I'm not saying you must trade news events, but what you could do is look for lower time frame SMT, like a few minutes before, like 30 minutes, start looking if there's some kind of SMT being started on the news event before the news event occurs. So look if there's SMT, and like, for example, let's say it's you're looking at gold and you find an SMT on like I don't know, 1 hour or 15 minutes or something. It's most of the time, not saying all the time, 80%, at least 80% of the time, that SMT, that's going to be protected because there's a manipulation there, and that will be the direction of the news event. Not saying go trade news, because I don't trade news. I'm just saying that that's a regular occurrence that I've seen many, many times happen from my own personal experience. I don't trade news myself, but I've often seen that when there's a SMT before the news event, like 15 or 5 or whatever, a few minutes, half an hour, generally that SMT is going to be protected and price is going to distribute in the direction of the SMT. You can go and test it yourself, but time is of the essence here, so I can't really show you all of the times there was news, but it's something you'll have to go and look at. So I wouldn't say there's a direct linkage between the IPTA and news, because IPTA is the interbank price delivery algorithm, and all it's doing is delivering price to us on our platforms. Sorry, like MT4 or MT5, TradingView, it's delivering price. Back in the day before TradingView or before MetaTrader, things was done manually. You'd call your broker and you'd say, I want to buy GBP USD. You call your broker and then you put in a position kind of thing. You can't see charts. There's no charts. You have to trade blindly. So now things is electronic, and the IPTA is an electronic algorithm that would deliver price efficiently for us as retail traders, interbank price action. All of that is the IPTA. So when you ask me, is there a direct linkage between the news? My honest answer to that is I have no clue, because I don't trade news and I don't really care either for news. The only news I actually care about is something like an NFP or interest rate decision. Every other news is just garbage, in my opinion, and fundamentals is nothing, because orders is where the price moves from, not fundamentals. Fundamentals is what the politicians and the government say, but at the end of the result, the central bank makes the decision of what price will do on the commodity, on the indices, on the dollar, on the pound, or whatever. It is the central bank that is moving order and price. So it's got nothing to do with the actual news. Many times, and if you've stuck with me all this time, I'm sure you've seen many occurrences where you don't even have to look at what the news is or the numbers, and you can say, this is why it happened because this is the chart data that told me so. So maybe there's a linkage between the news and IPTA. If there is, I don't know, because I don't really care about news. So IPTA is IPTA, you know. You can do more digging if you want to. There's a lot of ICT content now freely available on his YouTube. You're more than welcome to go watch it. I would recommend watching it anyway. But yeah, if there's a linkage, I don't know about it, to be honest. I'm not going to bloat lies to you because I don't know if there is or isn't. Okay. And then you asked me, how do you enter with a tight stop loss using SMT? Can we enter it at the moment we saw SMT? And yes, you can definitely enter the moment you see SMT. So I think yesterday would be a good example, Vivakaran, because yesterday you did sell GU and then you got stopped out. But if we look here, I think when we saw this, so this was yesterday's price action somewhere around here. Let's just go to a bit of a bigger one. So yesterday there was this price action. Today is the 7th, so it would have been the 6th. So somewhere around here maybe, in this little zone there. That's where sort of roughly I think you would have entered your sell position over there. So let's just go quickly here down to that 1 minute over there. Is that right, Tivakaran? You sold, right?
Yeah.
Okay, so let's just have a look here. So obviously you had identified
It's that 15 minutes imbalance that you shown yesterday.
Yeah, that's the 1 hour imbalance. Yeah, somewhere over here. Okay, so when you obviously you saw this maybe, because I can see this one over here, there would have been something like that, where price would have made a higher low, and then price was maybe making a higher high over there, and I think you would have entered over here, somewhere around there.
Right.
Okay,
Yeah.
and then obviously you would have been in the trade, and then you would have probably put your stop loss above the high, right?
Right.
Okay, so only to get knocked out, unfortunately. But what a lot of the time can happen is that sometimes there's more than just one manipulation. So here you can actually see another one. And it's sort of, if you think of it like building an order, right? So
Okay.
they can't just sell and then boom, price drops. Sometimes, sure. Sometimes this could have been the great trade and then price would have just dropped from here straight. You know, like on, I think it was on Tuesday where it just took the high and then just shot down lower and kept trading lower.
Right.
Sometimes it's just super clean like that. Okay. And if you saw the manipulation, you entered the trade, boom, done and dusted, you would have had a fantastic trade. Other times, price a little bit more tricky. Okay. And oftentimes, they will make a first distribution like this, because this would have been the first distribution over here on this one. Okay, and what we can say about this is if our bias, and we are wanting, because remember we established a bias, right? We established that we want to be sellers, right? Based on like a 1 hour, based on a 4 hour, based on maybe a daily or a weekly. We wanted to anticipate that price would sell, right? So we used the idea of the higher time frame as the bias of what direction price should generally go. Then we went down to a lower time frame on a 1 hour and possibly maybe a 4 hour you used. And we said that in this 1 hour zone of this SIBI, we would anticipate price to sell. Now, as soon as it closed the SIBI, we could have been sellers and then placed our stop loss above the Asia high. I personally don't do that. I wait for it to get into a confirmation, like a SIBI, like an order block, like an old high, like a whatever mitigation block. Okay, whatever confirmation you want. So our confirmation for this particular trade would have been the 1 hour, right? SIBI. When it closed the 1 hour SIBI, there's nothing wrong with this trade setup that you took here. The only problem is you got knocked out. Okay, which is fine. There's no problem in that. And it's fine to take losses. You broke even this time. But what you should have done is your bias should have stayed the same, because just because you were knocked out here, you shouldn't have a fear to trade the next one. And if you traded the next one, that would have been this one over here. So here price is sort of making this equal lows here, like that. And then over here, this is making a lower high over here. Maybe you can't see that, but if I do this, it's sort of easier and more visible there. So we can see there that the dollar index was making a sort of an equal low here, whereas GU was making a lower high. So that is mitigation over here. So there was an order here, and there's an order here. And what you'll actually find a lot of the time is that if you've chosen the correct bias, and sometimes you'll be wrong, you know, you'll choose the wrong bias, which is fine. But a lot of the time, if your bias is correct and it's linked to the higher time frame, these areas that create manipulation over here, and you can go and study this, these are actually what we can refer to as a reclaimed block, where an order block is formed, okay, or an order is placed, and when price comes back there, it will resell.
Okay.
So think of this like an order, and think of this like an order. So they're manipulating here, right? There's an order block here, and then boom, price drops. Then they trade higher over here, and what does price do? It manipulates again, and then it distributes from that point. Notice how it doesn't really spend a lot of time here, it just drops off there. And that's because there's an order here, and we refer to this as a reclaimed block. So while price is going up, they're selling into the up move. Okay, but a confirmed sell in this perspective is an SMT manipulation sell, price trades through it, and then sell again. Think of this like SMT and then RSMT, SMT. Because RSMT doesn't necessarily mean that price can only trade to the void or only trade to the order block, because there's 3 institutional reference points: old high, order block, void, right? So when those 3 institutional reference points are created and SMT is at that zone, SMT is an indication of manipulation. It's an indication of an order being placed in the opposite direction because they are manipulating price. So when it creates SMT, although it doesn't return back here and sell again, it trades higher, it is returning back to an old high, which is an institutional reference point. And this move here would have done what? Well, there would have been liquidity there above that high, because there would have been this small retracement, and they say, oh, well, this is resistance over here. Now, personally, I can't always catch these moves here because they happen actually quite quickly. This is a 1-minute chart, right? So it's not physically possible to catch every single move like this every single day, okay? But there will be times, maybe once a week, once or twice a week, where you can identify this in the market. Obviously, this will just be reversed for when it's a buy over here, because then it will be just accumulation and not distribution. But an order is placed here. And the same here, an order is placed here, and boom, price just blasts off from that zone because they've built in an order, and there's no more reason to keep price any higher, and then price distribute over here. So your question is, how do you enter off of a 1-minute chart? So if we sort of zoom in here, maybe we can just pull this across here, just to see and pretend that this was like something like a live price action over here. So let's say that we saw this move over here, and then you tried to sell over here. So maybe you tried to sell this sort of this high over here, maybe this like order block, little 1 minute here, a retest of this, and then you put your stop above here, and then boom, price decided to trade a little bit lower here. And you could see there even more that when the dollar index over here was trading lower than this low, you can see that still GU is not trading that much higher than this high, and that already alone is an indication of manipulation over here. The fact that the dollar index is able to break this low, but GU is not. You can see that it's under distribution. And then, boom, it trades higher there, okay? And yeah, sure, the DXY trades higher, but then what does it start to do? Well, those orders have been now activated. So what is essentially happening here? That the central banks or the higher players in the game have put orders there. Think of it like a sell limit of whatever, 2,000 lots. What do? They push price into this limit order, and then price hits like a wall and it can't go higher anymore. While the DXY is going lower, GU is unable over here, and then we get this. So as soon as you see this, you see that it bottoms out here, and it starts to make sort of these equal lows, while this is making lower highs here. You can be a seller right there, and you put your stop just above there. And the distance between this over here and here could be 5 pips, it could be 8 pips, but generally it's going to be quite low, because it's going to be generally, unless it was like last week where a 1 minute candle was like 50 pips, generally it's going to be less than 10 pips. And that's fine. If you take a stop loss, it's fine. It's not a problem. What was your stop loss size here, Sivakaran, over here?
It was around 10 pips.
10 pips. Okay, so what?
Yeah.
You got knocked out 10 pips, right? You take another trade, 10 pips. Okay? I'm sure there would have been 10 pips here. You would have been safe. You take another trade, and that trade would have given you, I don't know, like however how long you would have held it, but let's just say you wanted to target the Asia low, right? I mean, that was ridiculous on that move. So if you had taken that trade there yesterday at this zone here, just to target this Asia low here, from there to here is more than 60 pips. So let's just say 50 pips. That's 1 to 5 on your 10 pip stop loss. So what if you got knocked out there on the 1 minute chart over here? If you took your trade over here at this zone on the 1 minute chart right there, and you got knocked out here because you put your stop above there, that's fine. You lost 10 pips. But then you saw another SMT over there. Why not do the same? Your bias didn't change. Here's that 1 hour SIBI over here, this little purple line. Right?
Nodi, I actually, the problem is at first time, right, when the SMT happened, but it was broken. The high of the GU was broken. So second time, right, since DXY also falling low, right, I thought this high will also get broken. So that's why I didn't enter the trade. I saw this also, but I thought this high will also get broken. So I didn't enter it on the second time.
And that's fine too. Sometimes you catch it, sometimes you don't. But be aware of this condition in the marketplace, is that sometimes you'll get manipulation, and then it will manipulate a second time over here. And then that will push price lower. Maybe on the second time, maybe on the third time, I don't know. But maybe you took 3 trades and you lost 2. You lost minus 2R, but you made 1 to 5. So you net positive of 3R. The losses you took are irrelevant, because this is a strategy, okay, that allows for high reward ratios. As long as you're patient. If you're not patient, well, then it's not high reward, because you know you have to be patient. Okay, and then I said that this over here, before the daily candle closed, we could anticipate that this over here is a daily order block. Okay, why? Because if price is going to continue to sell, this up close candle over here is going to be traded through. Okay, we can't say that yesterday had created the daily order block, because it's not really showing that. It's just a wick there. But in terms of what we see on that 5 minute, there's a response there. Okay, we can't deny that there's a response here from trading lower and reselling over here. So I was able to get in a trade before this range over here was broken. So that's what I like to do. I don't like to take a trade at the sell side liquidity. So generally I try to find like a smaller time frame of a 1 minute or something to get in a trade over here before the range is broken, so that if it does reverse, I can just break even and not worry about the trade. And then for there,
Okay.
it wasn't my greatest work, but I was able to catch, I think, like 20 pips here. And then later on in the day, if you were patient enough, there was this over here where it retested this 1 hour void. Why? Because this is a low resistance liquidity run, returning to fair value over here. And on that zone, if we was patient and we watched the 1 minute over there, there was manipulation right there. That was SMT over there on this 1 hour closure. And just that trade, like I said when I posted that video, if we had taken the trade here or near this order block, our exit would be down here at yesterday or the previous day's low, okay? Or price should return to the weekly open, and it did. Look at that. Here's the weekly open. Why is that significant? Well, the weekly open is significant because depending on which direction price is going to go, it's going to return back to the weekly so that it can continue to expand. Gives like sort of a second chance, if you will. Okay. Long answer to that question of how you can enter, but in the probably in the next session, I'm going to show you some of my techniques that I would use to find or identify a trade. I've got like at least 5 I can show you that will allow you to get in on the trade.
Can you show me 1 hour GU chart on TradingView?
Sorry, can I do what?
Can you show me 1 hour time frame chart on GU on TradingView?
Okay. What would you like to see?
Okay. Can you just double click on GU so that only we will see GU? Yesterday, right, there was another plan for me. That is exactly on the 1 hour time frame chart of GU to go for a buy. Okay.
To go for a buy.
Yeah, and I didn't enter the trade because I was not able to see SMT. It was very quick actually. The 1 hour there was a void at. Sorry, can you keep the time frame as 2 hours?
Guys, this meeting is going to end now, so let me just quickly make another meeting, or we'll join back on the same one here quickly, and then we can resume.
Okay. There's a 2 hour.
Sorry, go ahead.
Yeah, there's a 2 hour. Am I audible?
Yeah, go ahead.
Yeah, so on your left, right, there's a void, right, on 2 hour time frame. Below that, below. Yeah, exactly the same point. I wanted to go for a counter buy trade on GU on that place. And if I shift the time frame to 1 hour, I could see an order block. I think you call them as nested order block, right?
Yeah, it's nested, yeah, because it's inside another array. So on what time frame?
On 1 hour.
Over here.
That one, that red one. Yeah. I actually wanted to enter. I marked the zones perfectly, but if you shift to 1 minute time frame, right, it was so quick. I'm not able to see an SMT. It was a candle. It just punched and went back. Yeah.
Here's SMT right there.
So okay. So here the entry will be at
your entry could be, I'll show you now. So there's actually 2 here. There's 2 SMTs. This is what we refer to as DSMT, where you have an SMT and then there's actually another SMT inside the SMT. So think of like a 4-hour order block with inside the 4-hour order block, there's a 1-hour order block or a 15-minute order block, sort of like a nested order block. Well, DSMT works the same, where we've got an SMT here of this larger area, but then on this smaller area, we can see that price is still going higher there and still going higher there. So there's actually two. So really you could have entered or put a limit order on that little zone there, maybe at the order block, because remember, you can still enter, put a limit. If you identify SMT, you can put a limit order. You don't have to execute immediately. You can execute immediately, no problem. But what you want to do is try and find an area of order block or a void that gets created or something. So let's say that over here, you can actually see that the moment that this low was not taken, do you see that? So it made a low here, closed, tested your order block, rallied away. The moment that SMT happened, which is before this one happened, so let's just look at the first one. This guy here, right there. The moment that the DXY was trading higher, you can see that GU was not trading lower than this low, right? Over there, because here is where the SMT happened, right there. So you can be a person who enters right there, puts your stop just below this low here, or if you miss that move, this is SMT, SMT expansion, retracement into what? Well, the order block right there.
Okay.
So remember that SMT, think of it like this, SMT, right? Let's just look at it like this. SMT is this, right? So here we have a high, or let's just do it in reverse because that's a buy one over here. So when the dollar index, or sorry, when GU made a low here, it made a low and then it traded higher and then it was trading lower, but at the same time the dollar index made a high and then it made another high over here. So immediately, as soon as the dollar index penetrates that high there and takes this orders, okay, why did GU not take those orders at a zone where you potentially wanted to buy anyway, which was a 1 hour or a 2 hour or whatever your confirmation was, right? So the moment that happened, SMT was created like that, right? And then when it was created, there was a order block here. Because what is essentially an order block? It is a sell to buy, right? So if SMT is involved and there's an expansion, what is that? Well, old low, order block, void, liquidity void, right? So you can take the trade on execution or put a limit order on that order block that you find on the 1 minute or at the closure of the void. So either you take the order block retest or you put your order market execution, or you place a limit on the liquidity void of that 1 minute and then you put your stop just below that old low there. And that's a perfectly fine trade. However, it was against at least like the 1 hour, the 30-minute, and all the lower time frames order flow, right? So this would have likely just been maybe a quick scalp for a small retracement, okay? Because if that was your trade and was against the order flow, that the way the orders were flowing yesterday, then taking a trade, where was it now? On the 1 hour, somewhere over here, right? Was it here?
Yeah.
Okay, so taking this order, you would have at least wanted to target the closure of this void. So sort of roughly down here, maybe you entered. That's still a good trade, even though it's against the way the orders are flowing at that given time. There's still a reason to take an entry and take profit from. I mean, if you'd entered that trade there, let's just have a look here. So if I put this here and then I go back to that 1 minute, there's that SMT that we saw over there. Here's the order block that we saw over here. And if you had taken an entry on maybe at the top of this void over here because you saw expansion right there, or maybe you were patient enough and you put a limit order on the order block, You could even put, if you wanted to, put your stop just below here, below this low, because there's SMT right there, or down here. I mean, 13 pips is not going to kill you compared to whatever, 5. Either way, it's up to you to decide what your risk will be. Either you put your stop just below the low or below the other low. One of them must be put where your stop is. And then you could have just closed this void here. There's this big void here. You could have just maybe even tested this mitigation here. I mean, that's still 50 pips. And even if you take a below this low, let's say that's 14 pips, and you're retesting this mitigation over here. So you've got a 13 pip stop loss to catch 46 pips. I mean, that's still a pretty good trade if you've got a 46 and a 14 pips stop loss. That's still a 1 to 3. I still say that's pretty good. And you can do that a few times, no problem. So there's no harm in that entry that you found. And you asked me the other day, how do you see accumulation on the pound or whatever you're trading? Well, think of this in reverse to what distribution would look like. It looks exactly the same, doesn't it? This is a failure swing to go lower instead of a failure swing to go higher. So this is accumulation. It's just reverse to distribution. It's the same thing, but in reverse. This is distribution if it's selling, but this is accumulation because it's buying. So accumulation is to buy, distribution is to sell. And it could have been in reverse. It could have, instead of being accumulation and a mitigation, it could have been accumulation and turtle soup, because maybe there was a lower low on the pound, but the dollar index made a failure swing. You know? So either way, good trade. I don't find anything wrong with that. It's just execution maybe was your problem because you didn't take the trade. But never be fearful. Never be fearful of losing a trade, because every trade, every single trade you enter, every single trade I enter, I never know if that trade's going to win. I could hit stop loss, but that's where the risk factor comes in, because you're not going to put a 10% risk on the one trade because you think that this is now, it's got 10 confirmations and triple SMT, and you never know. I never know. That's why myself, I don't risk, 1 or 2%. I'm risking 0.5, 0.25, and obviously maybe you'll have to risk a bit more if you've got a smaller account. But I mean, let's just do the numbers. Let's say hypothetically that you don't have a $100,000 account and you have to risk 0.5%, and let's just say you've got a $1,000 account. You can still take a 0.1 lot size, which would have been $40 or so. That's pretty good for $1,000. That's a pretty substantial amount of money. Not so? I don't know what 40 divided by 4%. 4% on a trade is pretty good, I think. If you're risking only 0.5, that's a pretty good return on investment. So what if you get a couple of losses in a row? Could be 2 losses in a row, 3 losses in a row, but so what? When you're catching and you're working on the progress that I can see that you know how to do it, because not many people would have been able to identify this. Soon enough, you'll be able to have the confidence to not put your stop loss here, but put your stop loss here. Now, by doing that, okay, when we look at it from this perspective, if we had taken a trade setup here, and let's say, I don't know, we put our order in here and we put our stop loss just below here and we rounded it up to about 5 pips over here, it's half the distance over here. So we said that over there, when we did our position size, 5 pips, we're using a 0.1. But obviously we can't use a 0.1 because we were using a 14 pip stop loss. We're halving the lot size. So the tighter your stops, the more R it is. Think of it like this, right? It's easier to catch 30 pips than it is to catch 300 pips. Would you agree?
Yeah.
So what if you take 3 losses in a row to get 30 pips, because then at least you'll maybe break even. But that one trade could be a 1 to 5, 1 to 6, 1 to 10, depending on how tight your stop loss is. So that's the way I see it. My risk, my accuracy takes a knock, but it's at no cost to the risk reward value. Never be fearful of losing, because you never know which trade, whether it's this trade that's the next one, the one before it, each trade has the opportunity to either make you money or lose you money, but that's where you just decide on the risk. And as long as you're not risking too much, you're going to be profitable, because you might be wrong this trade, the next trade, but the following trade you're going to win. And that's the mindset that we need to have. The previous trade has got nothing to do with the next trade. So if we lost the previous trade we took 5 minutes ago and we enter the next trade now in the next 15 minutes, it's got nothing to do, because we lost, it's got nothing to do with the outcome of the following trade. It is our emotional being, our mind, that attaches itself to make us believe that the outcome of this current trade we're going to take is somehow associated to the loss we just took. There's no connection. It is in our mind and our emotion that creates this monetary connection, because we lost the previous trade. So we think somehow that it's influenced on the next trade, but it's really not. Because if you've got a strategy and the strategy presents itself, and the strategy, you applied it, you executed it timelessly, it's just a matter of time, or a matter of sequences of trades, before one of the trades is a winner. And it might be a 30% accuracy on your strategy. It might be a 50%, 60%. That's something you'll have to build. I can't say for you, but for me, I know that I'm about 50% of the time I'm accurate. So that means that if I take 10 trades, I might lose 5 of them, but I'm catching 1 to 5 or more. So that whole mindset shift needs to take place. And this, Samad, is one of the questions you asked about psychology. What is psychology? Well, it is the psychological, emotional attachment that we have towards realistic or live money in the account. So it's one thing to trade a demo account, but it's another whole emotional aspect of our human being to see wins and losses unfold in a series of trades. So when we're losing, it's not nice to lose. It takes over our emotion. It's like fight or flight kind of mentality, survival instinct, if you will. You know, Randy Howell talks about this. He's a very profound psychologist for trading. Talks about things that, you know, when we were Homo sapiens and we were in the past, and we used to hunt to survive and kill animals with hunting, gathering, and all of that stuff. He talks about we were human and we had to be fight or flight instinct. So psychology is just the emotional part of the brain, that instead of the logical side of our brain, because remember, we've got a logical side and sort of an emotional side of that area, our emotion takes control of our logical decision-making brain. And because of that, we make stupid mistakes. And I do too. I sometimes make stupid mistakes, or I enter too soon or too late, or I sometimes think that price gonna fall, and I enter a position and I lose it, and then, you know, I still suffer myself with psychology. So it's an ongoing process. You're never gonna detach yourself from it. It's more of many people say, oh, you must just detach your emotions from your account. You can't do that. The realistic way to do it is to embrace those emotions, not to disregard them, because they'll always be there. You have to embrace that. You cannot just disregard them. Okay, so I'm taking too much time here to answer 1 or 2 questions. Okay, so Samad, so there's a bit of answer to your question of what trading psychology is. Okay, so Alex, you asked me a question. I'm not sure about external range liquidity and internal range liquidity. Under what circumstances external range or internal range liquidity is rated? Do we evaluate the weightage of the drawn liquidity above or below the current price action, or do we consider daily trading range of a particular pair? Thanks for sharing SMT, a good tool for quick scalping. I have lots more to explore my own. Okay, so basically you want to know more about internal range liquidity and external range liquidity. Okay, quickly, it's very easy to understand internal and external range liquidity. So on one time frame, price makes a low and moves higher, and from that high it makes then the low. So from this area here to this area here is liquidity up top there and liquidity down here. Now let's say this is a 4-hour chart or a daily chart, so let's say that is H4 or daily over here. This swing of price action going higher here, okay, is a trading range, right? And on the 4-hour and the daily, this just looks like a couple of candles higher, or maybe one candle, depending on what time frame you're looking at. But all of this at the below here will be external range liquidity on this time frame and external range liquidity on this time frame, on that particular time frame, on the daily or the 4-hour. But what we don't see is that if we were to zoom in on this price action here, on this big move, on like a 1 hour, maybe a 30-minute, 5-minute, 15-minute, or any time frame lower than H4 or the D1, what we don't see in this big upwards move is the lower time frame likely would have done something like this, gone lower, maybe trade a little bit sideways, gone higher, then trade a little bit sideways, take a little bit of liquidity, trade higher, and then do something like that. So it's the same move where this is the same low over here as this one, and then price decided to stop going higher and then go lower. It is the same thing. This is still the external range liquidity of this high over there. It's the same thing, but the only difference is that now from the 4-hour to the daily, this is external range liquidity, but on this lower time frame of maybe if it's a 2-hour, 1 hour, whatever lower time frame you use, all of this over here is going to be what?
Yeah.
Internal range liquidity. And internal range liquidity isn't only classified as the sell stops over here, because it could be a void, could be an order block. Okay, it's internal range liquidity. Okay, so while the bigger price swing over here on the 4-hour and the daily has made the swing low and the swing high, that is the external range liquidity, and everything in between on the lower time frame that you see of this big swing is internal range liquidity. So if we are trading from, I don't know, let's say that down here in this area we find an order block and a void maybe, and this little bit of equal lows sitting over here, and when price trades down in here, when we get there, does maybe price produce some kind of SMT here? Okay, and then we take a buy and then we put our stop loss just below here. So we take a buy there, we are trading internal range liquidity. So if we are trading and we are buying this internal range liquidity, where do we exit internal range liquidity trades? At the external range liquidity. So our target would be up top here. Now, obviously, if the order flow is bullish, then that's obviously a likely target, that it would target the external range liquidity. Okay, but sometimes your bias is wrong, and then boom, price goes up, doesn't get to the external range liquidity, and then it goes lower. So that doesn't always mean that just because we traded internal range liquidity, that we must always take profit at the external range liquidity. Okay, because there could have been inside of this price action, maybe like an order block over here, maybe something like that, and then price would have retested that order block, and then you would have taken no positions, and then you would have gotten no profits, because from your entry all the way trading up top here, it's already gone 80 pips, and you're catching 1 to 5, but you know that it's external range liquidity and you've taken no profits, then that is on you for not taking any profits. Okay, but the general rule of thumb is that if you are trading internal range liquidity, and internal range liquidity is what of the 3 institutional reference points? Anyone? What is internal range liquidity? Anyone? Give me some. Anyone? Emmanuel, you're quiet. Give me some internal range liquidity. If you are taking a trade of internal range liquidity, what is my confirmation to enter the trade?
Hi, good morning. Can you hear me?
Yes, go ahead.
Come again with the question. I've been late.
Okay, no problem. So you understand, I know you understand internal and external range liquidity, and this over here on the left-hand side is our 2 points of the H4 and the daily external range liquidity from the swing low and the swing high. But in the same price action leg, when price goes up here, this on the right-hand side here is the lower time frame structure that we see inside of that price leg. So if it is internal range liquidity, what am I trading?
If the lower time frame is,
yeah, what's going to be my confirmation?
A void.
Yes.
An order block.
Yes, exactly. So when we are trading internal range liquidity, we are likely trying to trade an order block or the closure of a void. Okay, so that is an internal range liquidity. And when we trade internal range liquidity, we are wanting or expecting price to go to the external range liquidity.
Yes.
But that does not by all means mean that if we've entered a trade here at the internal range liquidity, that we will never move our stop loss and we will never take profits unless the external range liquidity is hit, because then if you are doing that, you have learned nothing. Okay, and the reason for that is because if this moved down here and you've moved higher by whatever 50 or 30 pips and you're not taking any profits at like 1 to 5, then you are throwing money away. You're just giving it back to the market. So always look for areas where you can take some profits, scale out of the position, enter 2 positions, one at 1 to 3 and one at 1 to 5. Never just hold until where you think price is going to go. So when I entered my trade over here yesterday on the 1 hour on GU for this internal range liquidity, low resistance liquidity run, and then retesting and closing the SIBI here, where's the external range liquidity? Over here, right?
Yes, that's your external.
Yes, and I know that if I'm trading internal range, I'm looking for external range, but that does not mean that along this way here, I did not take any profit. I knew it was likely to go there because I know how price action works and I've seen this many times. But did I know that with 100% certainty that it would come here? No. So for that reason, I took some profits over here when I saw a reverse SMT occur here. And from here to here was more than 50 pips, which is generally my profit target anyway, which is 50 pips. So never believe that just because you're trading internal range liquidity, that it must go external range liquidity. Yes, it will most of the time because that's our understanding of price action. But if you're not taking something off the table and paying yourself, then all the work you did to get in this trade is for nothing. So always pay yourself as a reward for doing work, because trading is difficult, guys. It's one of the most difficult ways to make easy money. Okay? Many people think it's an easy way to make quick money. It's reverse. It's one of the most difficult ways to make easy money. Once you understand and get past the whole price action and ICT and emotional part, by all means, then we can say it's easy, because then it just comes down to the risk, the mindset, and applying yourself and your strategy trade after trade after trade. It didn't take me a week to get where I am right now. It took me years, guys. So I don't expect the same from you, that overnight you're just going to become a success. I'm accelerating that process for you guys because I'm showing you what I do. I never had someone to show me what I need to do. I learned directly from ICT, which is not a one-on-one situation like this. You get the videos, you're in his mentorship, and then you sort of on your own. And if you ever wanted to try to speak to him, you had to email him, and then you'd have to wait weeks for an answer. So the level of hands-on approach we have right now, is it's invaluable if you want to make a success of this trading. Okay, but okay, I'm bantering on now, but basically we are trading internal to external and external back to internal. So when we said that we are trading over, I think it was on Tuesday or Monday, okay, whenever it was, it took this liquidity, right? So it went external over here. Okay, that was an external range liquidity based trade idea, weekly order block, and we took the trade over here. So we would be looking that when price trades here and sells, where is internal range liquidity? Okay, so pretty easy off the 15-minute, we can see that there's sort of this trend line over here. So there's quite a bit of liquidity over there, right? Which is one area we can look to get out the trade. And then over here where price, if you follow this chart, there's a daily imbalance here. So external range to internal range. Why is internal range? Because internal range is the daily buy side imbalance, or the daily liquidity void that we found, which is this one over there when it traded to it over here. So, oh, whoopsie, this is a very messy chart. So let's just get a clean one here. Okay, so if we look here, so when we traded the external range liquidity by turtle souping that high over there, we went external and we are looking for internal. And then that was that move there. So that would have been your profit target. And sure, it may go lower, but we don't know that. Okay, so if we're not paying ourselves for the work we did to get in that trade and taking profits here, I mean, that's a substantial move over here. Trading external and going internal from here to here is 250 pips. Now, I'm not expecting everyone to have taken the trade on the high, but I mean, somewhere here, there would have been a retest and getting in the trade off of like a SIBI or some other entry technique. And your profit target would have been down here. You could have held a portion of the trade because the next day wouldn't have taken you out if you had entered up top here somewhere, because this didn't get close there. But you never know what trade is going to give you 100 pips, 50 pips, 1,000 pips, or whatever. I never know. I like to catch as many pips as I can, but I never know what's the outcome of the trade. That's why before I enter the trade, I like to know that if I enter this trade, where can it likely go to? Because then before I've entered the trade, I've already determined where my stop loss could be potentially. And if it's going to run in the direction I want it to, where's it going? So that's when I sent the video that I sent you guys yesterday. I gave you a breakdown of this price action over here on the 1 hour. And I said, this is how I assume price, especially on a Wednesday. It's very nice to do this, is that Monday made a low, made a high. Tuesday took out Monday's high, and Wednesday took out Tuesday's high. So there was a weekly order block reaction. Where is the high of the week generally created? At a higher time frame PDA. So if price traded lower, then my assumption of price was that we should trade lower than the previous day's low and target the weekly range. You can go watch that video I posted and you'll understand my assessment of what price action was. Okay. And I do this every week. I don't change anything. And sometimes I'm wrong, sometimes I'm right. So what? It's a give and take of the market. Okay, guys, so I'm not going to spend more time on there. I think I can answer another question here before this session ends and we have to start a new one. Let's have a look here. So upon detecting an SMT occurrence, how do you respond?
Oh, okay.
So quickly, I'll take your question now, Manuel. So quickly to make profit, especially in an M1 time frame. So if you go and rewind this recording, or in the at the start, we did discuss this, Alex. So I think you are not here right now on this call. That's fine. But you will see that I did answer this question. And then obviously I'm assuming that does the speed of your internet link matter? And the question isn't about really so much the link speed, okay? It is more about, and maybe you guys, some of you other guys don't know this, but we have what we call latency. Okay, and I think Thivakaran, you will know exactly what I'm talking about. Latency is the description of how long information takes to get from one point to another in milliseconds. It's measured in milliseconds. Okay, so from the link of my broker, from my internet connection to the broker's data center, it takes 86 milliseconds, which is just shy of 1 second. So 100 milliseconds is 1 second. So the higher this millisecond ratio is here, the higher your latency will be, and the lower the milliseconds, the lower your latency will be. So I will recommend that you try and pick a broker with a good latency to your country, and many brokers actually have different data centers in different countries to associate to, you know, where you are in the world. So you can choose like an account that's on like an Indian based server or a European based server to reduce that millisecond timing. And all this milliseconds basically means this latency, okay, the ping, okay, what this means is that it's got no influence on your internet speed, because if you've got a 20 megabit internet speed or a 40 megabit internet speed or a 100 megabit internet speed, it really doesn't make too much difference to the milliseconds, rather than the distance you are from where you are to where your broker is. So his question here, it's a very technical answer, okay, but this is the best way I can describe it, is that does the speed of your internet link matter? And the question directly is that no, your speed does not matter so much as your latency does. Because why? From the moment you click sell or buy, that's how long it takes for your broker to enter you into the market. And what you'll find is that you'll actually get better fills if you take orders from a sell limit or a buy limit. You'll actually get a lot less slippage. And especially if you are trading like a 5 lot. Okay, so you know, some of the trades I enter is 5 lot. Your order fill might have slippage. Okay, you guys probably don't experience that because you're trading like 50 lot, 0.50 or 0.20 or whatever. But the more lots you have, the higher chance of slippage occurs. Not so much if you're trading an old high or old low, but if you're trading anywhere else, there's slippage. Okay, you guys can go research what slippage is, but slippage is basically from the moment you click execute to where you actually get entered in might be 2 or 3 pips away from that entry point. So that was his question, and that's a very technical answer. Maybe it's going straight over you guys' heads as to what I'm actually saying here. But Thivakaran, do you know what I'm talking about?
Yeah, yes, please.
Okay, you'll know because you're also technically minded. Okay, so that was the answer for that question. Alex, you can go watch the video again. And any other preemptive steps you take, if you don't mind sharing. So something, I'll be sharing other setups or entry techniques or strategies, whatever you'd like to call them, from what I know and what I've developed for myself, and I'll teach that to you guys. I have shared a couple of them, you do know most of them, but there's a few ways to use what you've learned into a build yourself a strategy. And it's not, you know, once you have the tools like these concepts, you can really build yourself your own strategy because you know what this does and what that does and how this works with that. So you can really just customize your own strategy. And then obviously once you've developed something or thought up something, you'll have to go back test it or look for it in a chart or forward test it or wait for it to happen in the charts and then take like 20 or 30 trades of it to see if it's actually something that's going to work. That takes time. Okay. So there's a lot of questions I just answered there. Okay, I do see here, Samad, you've got a lot of questions over here that I'm going to answer. And then Emmanuel, you've also got some questions over here. This session is going to end now, so I'm just going to stop now. So you asked me, why did I not think that the highs of the Asia would be taken? Is that what your question was?
Yes, yes.
Okay, so
On a video that you posted.
Yeah. So did you watch the whole video?
Yes, I did, and I asked if the video it's that short or there's more.
Yeah, I think I ended it there, so I didn't say too much after that. So this is what I was seeing yesterday over here, and then we just make sure that we know where the open price is. So the open price of the week would have been this candle over there, roughly, something around there. Precise, not precise, but roughly there would have been the open of the week. And then we go here to the lower time frame, and then we look at the lower time frame. We know that over here was that weekly order block, right? Up here, all the way to the left.
Right.
There's that weekly order block over there, right? So we know that this area here is that weekly order block, right? Okay.
Yes.
So we knew that there was that higher time frame. We knew there was a turtle soup the previous day, and then there was this reaction, and then price sold. So the moment this reaction, price gave us, what happened? What happened was all of this here. What was this?
And then retail trade line liquidity.
Yeah, so this was a low resistance liquidity run. So before this, okay, let's say that I would have loved to have entered off of that trade, and unfortunately my internet connection went off, which is just something in life that just happens, okay? And I was upset. I can't deny the fact that I was upset, and I knew I would have taken that entry. But it didn't matter because I had anticipated that from that weekly zone, way back last week even, I said to us, we're going to get the reaction to sell from this area. Why? Not only because there's a weekly order block there, but because there was the DXY had also a weekly buy side imbalance that it was targeting. And when it got there, we had the reaction. Okay. So it sold off there. So Monday made a low over here. Okay. This is what I do every week. I do this every week. Okay. Probably on a Wednesday, I'll try and send them more if it's helpful to you in any way. So Monday made a low, right? Over there.
Yes.
And then if we follow the price action here, it had made a high. And then what happened to that high was that the very next day, this was Monday, Tuesday came, traded low in the Asia session and traded higher, and then kept going higher. So that day made a high, and then the market closed over here. So Tuesday took out Monday's high. It didn't take out Monday's low, but it took out Monday's high. So the order flow is flowing bullish, low resistance liquidity run, right? Again, anytime there was a high, what happened? Low resistance liquidity run until price traded into a higher time frame PDA of the weekly order block, okay? Or the weekly void. Okay, weekly void or weekly order block, both were higher time frame confirmations. Okay, then Tuesday's London session took out, Wednesday's London session took out Tuesday's high. And when it took out Tuesday's high, it was able to do what? Take out Tuesday's low. So from here, from the higher time frame, there was a low resistance liquidity run. So the order flow had changed on the lower time frame, having created this low resistance liquidity run. So my anticipation was that when this Asia highs was formed, I didn't want price to go higher than those Asia highs because it had already been bearish and come from a weekly area of significance. So I didn't want the Asia highs to be taken because there wouldn't be a need to take the Asia highs because it was bearish. And when price is very bullish or very bearish, it doesn't need to take the liquidity of the Asia highs because where is it now targeting? It's targeting sell side liquidity, right? So what you'll find in a bullish market that not always will price take the low of the Asia, or when it's very bearish, it may not take always the low of or the high of the Asia. Yeah, sometimes it can, sometimes it doesn't. In this particular case, it didn't, and I didn't want it to take the Asia highs because it was bearish. And at this zone here, there's actually a 4-hour. See there. So there wasn't a need for price to trade higher here because it had filled out this inefficiency here. You see, there wasn't like a
No, I get you.
there wasn't an objective for price to go more higher. There was more reason for price to go lower than there was for it to go higher.
Yes.
Because it went higher to fill the weekly imbalance, to test the order block, raid the high. So there wasn't any more reason for liquidity grabbing or filling of any inefficiency to go higher. It had already done that. Now where's it going? It's going for all of the buyers who got in this upward trend.
Yes.
And this gives us, okay, yesterday I said that the 4-hour wasn't bearish yet. I say now it's bearish because it created a low liquidity run here below this low. Because over here, until here, price is retracing. Because remember, the daily would still be bullish, right? Even now, I don't say the daily right now is bearish yet. It's still bullish, right? Would you agree?
Yes, I would agree.
Until I get a retest of area, maybe price trades into the SIBI here and then rejects, goes lower and closes lower, well, then I consider that this is now daily bearish. But for a while, 1, 2, 3, 4, 5, 6 days, price has been bullish and it's been expanding higher. So for me to say right now, because just 2 days of down candles, price is bearish, would be an incorrect assumption. The weekly is bearish, right? Monthly is bearish.
And the monthly is bearish.
Exactly. It just takes the higher time frames longer to turn in that favor. So going back to what I said over here, I didn't want the Asia highs to be taken because it already closed the SIBI on the 4-hour. So there wasn't a need for that highs to be raided. And in actual fact, if you zoomed in there on yesterday's price action, this here was SMT over there. So buy, sell into the up close candles, SMT, return to SMT, SMT, sell. SMT, RSMT, SMT, sell. And also, there was that SIBI I said over here that should be closed. Let me show you something else. This is a bearish candle. And on my charts, that is a bearish candle because it's black and that's the colors I use. And over here, this is a bullish candle. Okay, so what is this?
That's a high of the candle.
Okay, that's the high. What is this?
That's the open.
It's the open. What is this?
That's the close. That's the low.
Okay, so we got open, high, low, and close. What is this?
That's the high. That's the close. That's the open. And the low.
Exactly. So it's in reverse, but it's still the same thing. It's just the candle's green and it, opens low and closes higher. And if it's bearish, then it opens high and closes low. This simple structure is make or break for SMT, for order block, for everything. Everything in price action is this. Every ICT concept is this. Every ICT concept is this. If you know what all ICT concepts are, you know that they are all this. Every single one of them. Mitigation blocks, breakers, daily order blocks, voids, everything is this. Right?
Yes.
Because no matter what concept it is, whether it's an order block, whether it's a void, if price makes a bullish order block here, like this, and then trades higher here, all that price is doing is it's returning back here. That is the order block, right? But in actual fact, all it is, it's the open of that down close candle. It's the open. It's an order block, yes, but it's the open. It's price action in a nutshell. And it's the same if it's bearish. If this goes down over here, and that's a down closed candle, this open is the order block. And if this, trades lower, then over here, when price returns back higher, what is it returning back to? The low. Open, high, low, and close. It's the same concept of accumulate, manipulate, distribute. The open, price trades higher, open, the low, the high, and the close. If you've ever looked at this chart type, this is exactly all it is. It's just candlesticks, but what are they called? Bar charts. It's the same thing. Price opens, a low, high, and close. Obviously, if you do it from a higher time frame, when price is bullish, what is it doing? It's opening, it's going low, and it's going high, and it's closing higher. It's not closing lower. So what can we say here? This structure changes where it's opening low, making a low, a high, and a close. Open, high, low, and a close. OHLC, open, high, low, close. That's all it is. And then somewhere in here is order blocks and voids and mitigations and breakers and SMT and all of that. But all we are doing is we're trading price action on a 1 hour, on a 4 hour, on a daily, on a weekly, whatever. So when we are bearish, price opens, makes a high, makes a low, and closes lower. Right? When we're bearish.
Yes.
And when we're bullish, it's opening, making a low, and closing higher. So it's the same thing on a weekly. Open, low, high, and close. Notice how we're not closing. If price was to close right now, because it's not the weekly close right now, that's not a bullish candle because it's closing where it opened. If it was to close here, don't you think there'd be a void in there?
Yes, it will be.
Yeah, there would likely be a void there because it opened, it went low, and it's closed higher. So there'd be a weekly void over there if it closed up top here. Okay, there's still a couple of hours left for today, but it could close higher. I don't know. But that's why we say we have to wait for price action to tell us what it's going to tell us. We don't know. Price could rally right up and close higher, which would indicate to me my bias would likely change, because that is a weekly close of a higher price. That's all that price action is. All that ICT concept are is open, high, low, and close. If you understand that simple mechanism of price action, you can do anything you want. Because yesterday there was this beautiful setup, and it happens every single day. Okay, let me just go here to the 1 hour. Okay, and my pair is GU. Now I don't always look at other pairs or care too much to look at other pairs, because I don't need to. You know, I make money off GU, and why spend time looking at other things if I don't need to? Okay. So if I look at the price action here on this 1 hour chart, let's just make this a little bit wider here so it's easier to see. Okay, so we know there's a SIBI here yesterday. Okay, and let's just pull this DXY over here like that. Open, high, low, and close. Okay, so the open of this down close candle opened here, right?
Yes.
So we put an open there. So in retrospect, or in opposite to this open, where's the open of this? Right there. Okay, now I've taught you this before, guys, that once you understand what SMT is, you can apply it in any fashion you see fit. Okay, so look what's happening here. What do you see?
Where's the candle that you would like us to look?
This one. This bearish candle opened over here, right?
Yes, open over there.
Okay, so this candle is this bullish candle here, right?
Okay.
Yes.
Okay.
And open.
So exactly. So we know there's an inefficiency here. Okay, so it's likely that when this candle closed, price would have retraced to close this inefficiency, right? To take more orders to sell. Okay, so when price on the lower time frame, you know, okay, anyway, there we go. Let's look here. There's the 1 hour open price, right?
Yes.
Here's the 1 hour open price. Okay, so when price was trading above the open on GU, why was the DXY not trading below the open?
Manipulation.
Exactly, manipulation. And okay, I can't say I took this trade, but this is the exact replica of all the trades I ever take. Okay, all of them is linked somehow to this, what I'm showing you right here. So when price was trading above here, we can actually see this even on a 1 minute chart. So when price was trading above here on this 1 minute chart, we zoom right in there. Okay, I'm not an expert on trading view, so forgive me for my mishaps. What do we see here? We see that this is the 1 hour. So theoretically, if price was symmetrical, then price on the DXY should also be moving below the open, because GU is moving above the open, right? Open, high, low, and close. And it's not. So the fact that it's not is manipulation in itself. Forget swing high and swing low. I'm talking order blocks, voids, opens, closes. The candlestick itself has SMT in it. because it's being manipulated. So over here, we should anticipate that the DXY should trade below the 1 hour open, but it's not. So that is a higher time frame SMT, plus there's a void there. Okay, now we're getting lower time frame manipulations. And this is where the key comes in, is understanding a little bit of the higher time frame. And a higher time frame could be 4 hour, 1 hour. It doesn't have to be weekly stuff. Okay, we could trade a 1 hour to a 1 minute. That's fine, no problem with that. But what's key is to understand the higher time frame aspect of the SMT, coupling it with the lower time frame. That's where the key really is to getting tight stop losses. Because here, price sold
Okay.
and SMT'd in an already SMT'd area. There's SMT because price didn't go below the open. And there's again SMT here because it's showing you SMT on the 1 minute. And this is
SMT on a high time frame in the lower time frame.
And this is just one case. You know, this is from yesterday. I haven't really looked at the chart today. I don't really care. But this doesn't just happen, you know, once a week. This happens every single day. Every single day there's a trade set up. Whether or not you trade them, that's up to you. But every single day there is something going on if you know how to read the price action.
Yes. Okay, sir. Where do you, this scenario, you get entry?
Where do you get entry?
Yeah.
The SMT.
On the SMT.
If there is a manipulation and you notice it, then that's your entry.
Yeah, it really depends, Samad, because some of us, we can't sit on the charts on a 1 minute chart for an hour or 2 hours because we have jobs or, you know, we have things to do. So sometimes you may not always get the best entry, but I mean, if you watch a 1 minute chart, then you can. If you can't, then watch a 5 minute. If you can't, watch a 15 minute. And all you need to do is you take the trade based on what you see and you place your sell, your stop loss above the high. So your entry, okay, so Vakaran's entry that he took yesterday was over here where he saw this first manipulation and he got stopped out. There was one here and over here.
Yeah, already.
He got stopped out, okay? But again, it's higher time frame, so we were anticipating it to sell anyway, and you should have taken another entry over here. And I myself personally, I can't always be on a 1 minute chart watching it every second because it's physically impossible. I have to take my son to school, I have to eat breakfast, I have to drive. You can't always watch a 1 minute chart. Sometimes you can, sometimes you can't. And there's some days where you can, and if you can afford to do it, then do it. It will accelerate your learning process because what happens on a 1 minute happens on a 4 hour, happens on a daily. If you can read 1 minute price action, you'll know exactly what's happening on a daily. Or if you can read daily, you can read 1 minute. It's the exact same thing. No different. Don't be fooled because it's a 1 minute chart. It's as informational as a daily. So the answer, Samad, is that you take entry when you see manipulation and then you place an order. So here, if you zoom in there,
Okay.
the moment that you can see there's equal lows but a lower high here,
yeah,
that's when you take entry. Either you take it here and you get stopped out, which is fine because all they do, they take the high of this liquidity and then they sell again anyway, but it's the exact same thing. So if the DXY over here was making equal lows, then why was this not making equal highs?
run.
And what
Seriously,
remember that I've taught you how to read a PDA, right? So PDA starts with old high, rejection block, order block, void,
Points.
breaker, mitigation. So any one
Yes.
of those arrays can be SMT'd, right?
Oh, yeah.
So when price trades into this 1 minute rejection block here, right there,
Mm-hmm.
why did the DXY not trade into that rejection block over there? Or when one trades into the order block, the other one doesn't. Or when one closes the void, it doesn't. One doesn't. This is another setup that I have that I'll show you in the future. I call it the event horizon. Okay, also happens at least once a week, where you do it on a 1 hour chart and you find yourself a, let's just find the most recent one that I took yesterday. So when there's a void, okay, both voids should be closed. And if they are not, that is SMT. So, oh, this looks terrible. So over here, why does this void close and this one doesn't? That's SMT, right? This is a void and that's a void. So the price action should be symmetrical, right? They should be identical, but it's not. So when this one closes the void, this one does not. That is higher time frame SMT. And then when it gets there, we're anticipating it to sell. So how do we enter off of that? Well, if the confluence is the SIBI, because we are trading based on the idea that this SIBI has now been filled, that's the confirmation. What is the confluence? The confluence can come from your 1 minute time frame. Right? So when price gets in there, let's just go back quickly to that area. And this happens again. This happens all the time, every single day. Over here, where is that confluence? Over here, right there. So the SIBI fills, and over there is SMT. Right there, you can probably see that that one's making a lower low, and this one's making a equal high over there. Pretty visible, or even on this over here. Lower low, equal high. Happens all the time. 4 hours, 1 hours, dailies, anytime there's something of significance, you're looking for lower time frame SMT to take you in the trade. Because all very well, you've got a 4-hour order block that you find, or a 2-hour order block that you find, or a daily void that gets filled. How do you know that it's going to buy there or sell there? SMT is going to tell you. That's the confluence. It's adding another layer of, call it probability, in your favor for you to be correct. Are you always correct? No, of course not. That's where the risk part comes in, and psychology, and being able to take losses. But that's what I do every single day, that every single trade I take has got a confirmation of some sort, whether it be 1 or 2, it's fine, but it's always got also an SMT on it. If there's none of both, well, then I don't take the trade. Simple as that. Every single trade, every single day. And if you're in a trade, okay, and you sell it and it's running in your favor, oftentimes, if you know what the higher time frame bias is, you can use SMT to get you in another position, to add more. They always say, when you talk to traders, they say, close your losses and let your runners win, or your winners run, right? Or add more to a winning position, but never add to a losing position. So if you've got a higher time frame bias, why not use this as a reason or a method to add more to a winning trade? Because it's easier to add more positions on an already winning trade than it is to have no trades open and try and execute a new trade, because that psychological switch is that your account's already running in profit is easier for you to execute a new position than having no trades on and taking a new trade. That whole shift mindset is different. And anyone here who trades a live account will know exactly what I'm talking about.
Yeah, I know exactly what you're talking about.
Exactly, because it's easier to add to an already positive account on an additional position than it is to open an entirely new position. So that's where, although we can use what I'm showing you here as like a scalping technique, you can use it for swing trading. You can use it for intraday trading. The possibilities is endless.
And on S&P.
Sorry guys, my voice is going. I think I have COVID. But anyway, Emmanuel, I wasn't going to spend so much time on this, but let's just see if I can. This is something that's higher time frame, so it's not really sort of applicable to, you know, what's going to happen today, what's going to happen tomorrow, but like the rest of the week, next week, the following week, you know, commitment of traders. So let's have a look here. What did I click on? Pound, yeah. Okay, you can do this for anything, as oil, gold, I think Bitcoin even, if you want to do that stuff. I did send a link, so you can come and visit this link. Take you to this page, and then you just choose whatever you want to look at the COT data. But again, this is very higher time frame, so it's, you know, it's not going to really affect what's going to happen to price right this second, or this London session, for example. It'll take a bit of practice also to get used to this website, like how it looks and where the buttons are and whatever, but you want to come over here to study, and then you're going to scroll down here to commitment of traders, and then you're only going to select the commercials because that's where the smart money is. We don't care about the others. And then basically you're going to come here and you're going to start from like a higher time frame. Don't go, you can go higher, but then you're talking really, really long term. Okay, so you want to be working within the range of 1 to 3 months. Okay, you can, obviously the less you go, the more influential it is in the shorter term, and the higher you go, the more influential it is in the longer term. So for the purpose of this right now, okay, let's just do a 3 months, because that's 1 quarter, right?
Yes.
Okay, and if you know anything about COT data isn't changed every day. It's only changed like once a week. You get a new report. Let's just do a full page, yeah? So COT data is only released every Tuesday, I think. I don't know if it's Tuesday New York time or what time, but Tuesday's sometime in the world. Okay, so basically what I did show us yesterday was, you know, you're going to pick an area where you're going to see this occurring, okay, and it's not going to happen all the time, but basically, if we think of how smart money works, right, and an order block works, is they buy into downward moves or sell into upward moves. So any time where price is sort of the opposite, think of it like SMT, where they should be symmetrical, but they're not, okay, so when price is going up, okay, we would anticipate that they should be going down, for example. Okay, and then like I said, there's going to be times where, if I can find one here. Okay, so they're going to sell into an up move, and they're going to buy into a down move. So you're not looking for times where they are correlated, because then you know that they're just buying. For example, here, price just goes up, and this COT report's also going up, right? So for that time, they are correlated. But there are times where price is going down and COT data is going up. That means that they are going to form an order block on a higher time frame, because they are buying.
What data means the close price?
Sorry?
COT data means the close price.
COT
Close
data.
price.
No. COT data stands for commitment of traders report. So it's got nothing to do with closing price. COT data is basically What positions are they in? Net long or net short? Meaning, are they overall net positive to buy, or are they overall net negative to short? Okay, and the fluctuations going up or down tells us. Okay, so like here, Emmanuel, look at this. Price was going down, right?
Yes.
But what is happening here?
Higher high.
It's like kind of consolidation.
Samad, yes, you are correct. Higher high and lower low, but that's not really what I'm showing you here. I'm showing you that while the price is going down, they are buying into this downward move here.
Yeah. It's buying.
Okay, maybe it's easier to see it like that, and then we make this a bit larger here. Okay, now it's maybe a bit more easier to see. So while price is going down, the commitment of trading is going up. So we don't know when. The COT data isn't to tell us that, oh, we must buy now, because if we buy, obviously, in this down move, then you're going to have a lot of drawdown. It's to tell us a higher time frame, they are likely accumulating orders while they are selling to go long. So how would we trade this? Well, you watch this unfold, and then the first sign of a higher time frame PDA you buy, like a daily or a weekly order block, because then you know that move is substantial. It's not just a short little candle. You buy the higher time frame PDA. That's why this is higher time frame, not like 1 hour, 4 hour things. This is weekly, monthly things. This is long term. They buy into this down move.
I get you. I didn't understand the first part. Look like so now there's nothing that you inverted, or it's just normal as it is.
No. So there'll be times also, like for example here, right, where price is going down and the data is going down. That is a very bearish signal, because they are selling and the price is going down. You can see every week the COT data is lessening, meaning, and the chart's going down. So they are both going in the same direction, meaning that they are selling hard. Yeah, it's symmetrical. Okay. And there's going to be times where, like over here,
a quick question. Which one should we use as a how do you call it? The leading chart?
Leading chart for what?
So we don't use like kind of DXY and DU, like where DXY is a leading chart.
No. This has got nothing to do with that. You can, once you understand this, use COT data on the pound and COT data on the dollar index and associate them together to give you what could happen longer term. But that requires a great level of understanding of COT data, because then you can say that, oh, well, the COT data is bearish on GU, but the COT data on the DXY is bullish. So long term, I'm very bullish on the dollar index. You know, you have to know what you're looking for on the one and then look for it on the other. And if they are opposite to one another, one's buying, one's selling, boom, there you go. Long-term bias is bullish. Coupled with bullish weekly voids on a weekly, bullish order blocks on a weekly, monthly voids, monthly order blocks. This is not daily 4-hour kind of stuff.
It's like an investment.
Long-term. You can do this on oil or gold or whatever. It takes a lot of understanding to get to this knowledge. So I would recommend you go and watch the guys on, well, not the guys, the Michael on. He's got a whole library.
I do have a link that you sent, so all these videos are there. So I'll keep on watching. The reason why I asked this.
I'm going to do one more lesson with you guys, so we can join back on this link. So what I'm saying is that what you should look out for is either two things. Either the COT data and the chart data is moving in the same direction, which indicates a strong buy or a strong sell, or they are not moving in the same direction, which means that while price is going lower, and the COT data is going higher, there's going to be some kind of buy in the coming days or the coming weeks for a strong buy, because they are buying into the down candles. Or in reverse, COT data is going down and price is going up, meaning they are selling into the up close candles. So there's only two conditions: either it's moving in tandem or not moving in tandem. Bigger time frame, lower time frame. And this is just 3 months, right? Over here.
Yes.
So you could do it like 6 months if you want, but really it comes down to what you want to do with the data and how you want to use it. Okay, but again, it's like you say, it's like investment. It's not trade a daily order block and take profit at 50 pips. It's, you know, take a entry, 100 pip stop loss, 1000 pip target kind of thing. It's long term, you know, and this doesn't appeal to everyone because, you know, you have to have a lot of patience for this to play out. You know, we're talking things like, here's a daily order block, price makes a daily order block, you buy the order block and you wait for like 2 weeks to take profit. Swing trading, you know, it's not something that's going to give you profit tomorrow. You know, if you want to do that, then you trade turtle soups and SMT reversals.
Actually, they are weekly order blocks.
But I think it's worth it than to leave the money in the bank, don't you think?
To leave the money in the bank? Not a
Yes.
chance. I have almost zero money in my own bank account. Almost
Yes.
zero. I literally only have
That's
money
why.
to pay bills every month. All my other money is either in crypto or in my trading accounts of different brokers. I don't leave any money because it's a waste. There's no point leaving money in your bank. The bank, or actually your broker, is as safe as it is in a bank account.
Yes. Reason why I'm saying that is it's best to invest in your money than to leave it in the bank. The reason why I asked about this,
Yeah.
I got so much interest on this thing because I want to have a multiple account where I'll be investing on some scalping, on some intraday, on some. So the reason why I want to know more about this.
So when you trade like that, you're going to be focusing on taking entry off of a daily time frame and then using like daily, monthly, and weekly for entry,
Yes.
or to give you direction. And stop loss on those kinds of trades isn't as important as directional bias. Directional bias is more important because then that allows you to confidently add to the position, whether it's losing or whether it's winning. Okay, short-term trading is different because you don't really want to add trades to a loser. Whereas if price is going against you, it looks like it's going against you, but you add another position because all you know it's going down for a discount to go higher because you know what the higher time frame is.
Yes.
It takes a whole different kind of mindset to be a trader like that. But, you know, you can make money like that. There's no, that's how I used to trade. I never used to be able to watch a 1 minute chart or trade London sessions. I had to look at daily charts or weekly things and then do trend lines and moving averages because, you know, I had a job.
So one question.
I can't spend as much time as I do now on the charts because, you know, it's pointless. And even now, I've studied so much that I don't even work the whole day. I work from the London Open to about 2 p.m. and if nothing shows up, I'm done.
Yeah.
I don't even.
But sometimes. But sometime early some setups formed.
Yeah, sometimes there's a setup before the London, but if it's, you know, if it's happening too early, then I probably won't even happen or take it. So what I generally say is if the setup occurs in the European session, that's fine also. But anything before the European session, which is just 1 hour before London, so that's when the Frankfurt opens, there's volatility, there's price action, but anything before that German market open, don't even take it. That's my rule, at least. And I don't even trade after, you know, when the London market is closed at night for me, which is about 8 p.m. or so. I don't even care to trade. I might trade 1 or 2 setups here in New York session, but when the London market's closed, I'm done. I don't even care. But when you swing trading, it actually has irrelevance to, you know, when you enter the trade, because the entry is not as important or the stop loss and the entry is not as important as the you know, the directional bias, because you're going to be a part of those 1 minute swing lows and swing highs when you're trading on a higher time frame bias, and that stuff's irrelevant. Okay, so I know you guys like gold, so we can just do gold here. So I said to you that okay, first let's just look at this. We were going to just look at gold here. First silver. Okay, so this is what I said to you. The first time in a long time, the COT data turned.
Yes.
Yeah, they went open past the net negative. Let's just do this full one here. Gold is, silver is way undervalued. So the price that it actually is now is like super low in terms of precious metals, right? Because silver, if you don't know, is actually used in lots of things that are created in the world, like cell phones or computers or things like that, more so than gold, you know. And obviously, you know, these things they want to invest in. And you can buy silver now as well, like literally buy coins and things like that. And it's cheaper than gold, so more people will buy it. Okay, so let's just get a candlestick chart here, and then we add commitment of traders, speculators for commercial only, and then we go full chart. Okay, so obviously silver, gold has been bearish, right, for quite some time now. For most of the days and the weeks, etc. So you could see, like, if we look at it from a 3 months or short-term perspective, gold and silver's been bearish, right? So this is where it's at now, $20 or whatever. Okay, so it's come from a low, so from a high, sorry, and up to a high, down to a low. So you can see what's really happening here. It traded lower all the way down here, and then basically what was happening. But look what happened though.
Upward move.
So while this move down here was happening, right? What was happening to this data here?
Buying.
Yeah, they were buying. The commercials were buying. The commercials is the ones we follow, not large speculators or small speculators. We don't care about that. Don't even put it on the chart. It's irrelevant. Where's it going? If it's going down here and it's selling, right? Where's it going? It's going for liquidity, right?
Yes.
So we are not trying to catch the bottom with a 5 pip stop loss and trying to catch 100 pips for a 1 to 50. That's not the goal here. The goal here is to identify a trend in the market or a situation or a scenario here. So we know it's selling, right? And we know where's it going to sell into. Well, it's going to sell, and if it's going to buy, it's going to buy the sell side liquidity, right?
Yes.
So what do we know then from this? Well, it sells, and while it's selling, particularly here, what's happening to this COT data?
It's buying.
Exactly. So it's not like we have to try and buy, you know, below the low here. We could have maybe looked for an order block on like a 4-hour or a daily or a weekly or something to trade off there. But more importantly, we are looking to take the upwards move here because we know that this here would be some kind of higher time frame order block. This down candles was traded through, associated with this buying of COT data. It's a lasting effect. It's not something that just happens tomorrow, you know. And even here, look at this, right? So price is going up, right? What's happening to the COT data?
No.
It's going down. Look here, going up, price going up, COT data going down. So they are selling into the up move and buying into the down move. This is a 3 months chart, right? So it's not like, you know, daily things. You can trade daily arrays or weekly arrays, but this is 20 days, 40 days, 60 days, if the data range techniques. So if you know how to use that, in addition with a COT data, in addition with your PDAs on a higher time frame, monthly, weekly, daily, you will be set. This is swing trading, my friend. This is the best swing trading you can ever get. And I haven't really spoken so much about it, but there is also seasonal tendencies that occur in the market. Like in July month or August month, there's a tendency for gold to sell, or the dollar to buy in August, or the pound to sell in March. And
so I actually wanted to ask about the season tendency and the interest rate driven and the commitment of trader. It's something that I saw from the Michael's video.
Yeah, so
I don't know if it's a part of our
$1 million swing setup, right? $1 million swing setup is when all of this is aligned with each other. So for example, let's say that the interest rate on the dollar for the Fed interest rate decision is higher, right? So that means just by the interest rate change, that is a bullish signal for the dollar index, right? Okay, so number one, we've got an interest rate decision that is bullish for the dollar. Then let's say it's, you know, whatever, a month ago or 2 months ago, and we find that on the seasonal tendency chart, there is a tendency for the dollar to buy in, say, August and September. Okay, so that's number two. So interest rate, bullish signal, seasonal tendency, bullish signal. Then what do we notice? That there's a pullback on the dollar and the COT data is going up while the dollar is going down. What does that mean? Or
might be going down to something.
Yeah. Or the COT data is going up and the chart's going up. What does that mean? Strong buy. So it's three things from a macroeconomic perspective. Macroeconomic to micro technical. That's what ICT talks about. When all of these steps are aligned with one another and they give you a buy signal. It's not daily things, not 4-hour things. It is macroeconomics. That's why you don't need to know what the news is doing, because it's got nothing to do with news. Nothing. It's interest rates and that's it. And bonds. That's it. Oh yeah, and then obviously there's bonds as well that we can incorporate, but that too, I don't spend a lot of time on the bonds, but just know that bonds up, you know, interest rate down, bonds down, interest rate up, because a bond is basically a mortgage on a house. And obviously if interest rates go up, they make money more difficult to borrow. And when interest rates go down, it makes money easier to borrow. So when you go and get a mortgage or a home loan or a bond from the bank, depending on if the interest rate is lower or higher, it makes getting more money easier. So when the interest rate's high, you might get only a bond for $100,000. But when the interest rate is low, you might get a house or a mortgage approved for $200,000, hypothetically speaking. It just makes borrowing money easier or difficult, which is in turn affects the stock market, it affects commodity prices, it affects macroeconomics, the whole broad thing. Think of this, the dollar dominance, right? The dollar index is so strong, right? Which means the currency of the dollar is so strong. Forget the rest of the world. What currency do the rest of the emerging worlds use to buy anything? What is the world's currency?
It's the US.
Well, besides now Bitcoin, right? But they use dollars. So when Nigeria buys oil, when South Africa buys gas, when Turkey buys grain, when Ukraine sells oil, when Russia sells gas, when Europe buys oil, when any country does a transaction, what transaction are they doing it in? Are they doing it in their domestic currency?
Dollars.
No, they're using dollars. So that makes it difficult for emerging economies like South Africa, Gambia, the whole of Africa, any country that is poor. It makes it very difficult for them to do any kind of transaction because it's so expensive. Because now instead of the rand being only one dollar is 15 rand, it's now 17 rand. It's only $3 more, but when you're buying 50 million worth of that unit price, that makes a substantial difference in bigger portions of it. So that's why we can see that the influence of the dollar dominance, which is the strength of the dollar, impacts the entire world. Because the dollar is so strong, it impacts every single economy in the world. And inflation in your country, interest rates in your own country. Because if the dollar is weakening, that's easier to do business because the dollar's cheaper.
That's true. That's very true.
This is macroeconomics, guys. I'm not talking like trading a London session with a 5-pip stop loss. I'm talking about the whole world economy here. And I would have actually, looking back in retrospect, I would have loved to actually study in school and get like a PhD in economics rather than being a network engineer. But, you know, I can't change my life. But, you know, I could recommend that to anyone who wants to study something and they want to do trading. ICT and economics, my goodness, you'd be an awesome trader. Okay, but anyway, so this is silver, and then we see here basically that what is price doing again now. So this is a 3-month outlook on what price is doing. So here we first saw that the price was going down into the sell side liquidity over here. Sell side liquidity over here, and then price buys under the sell side liquidity while the choch data is going higher. Now you don't see what's going to happen longer term, so that means that you'd have to step one out and go backwards into a higher time frame. So when we look at now a 6-month chart, the perspective shift is different. Because you can see more data now, right? So instead of just seeing 3 months, you're looking at 6 months. Look what's happening here, guys. You don't see this on the 3-month chart. What's happening here? You see the problem with this? Yeah, you see this. The problem with this, Emmanuel, is that if we see this and we see the choch data going up, but the chart's going down, and we try to buy it, you know how much we could be a part of all of this drawdown. And obviously, you know, it's difficult to trade like that because we'd be in a drawdown. But we know they're buying. So this where it comes in is that if we know that the choch data is going up, but the price is going down, we really just, in this case, have to be patient. Because we would have to wait for a weekly or daily or monthly something to be able to buy this, because we don't have the funds available to us to sit through all of this drawdown. Like even if we were to take a 0.01 lot size, that is, you would have probably blown $1,000 account or have like $2,000 drawdown, because that's like 22 to 18. That's so that's like $4,000 if you took a 0.01 lot size. $4,000 drawdown. So you can't do that. It's impossible. So it's our job to identify this and then trade the lower time frame once it reacts. The lower time frame being maybe a monthly, maybe a weekly, because this is a 6 months chart and there's 4 candles in a week. So 4 times 6, 24. 24 candles, 24 weekly candles for us to be able to take a trade. Or riding it out, Maybe we saw a sell position and then we take the sell. But what we can see though, what do we notice overall now that I've zoomed out here on a 6 months? What do we notice what's happening? Let's just delete these. What do we notice what's happening in the chart? Overall, let's do this. Where is it now? Here's a line chart. Oh, there we go. So if I put this here like that and make this a bit bigger here and then pull this here like that, what's happening?
Oh,
Big time frame. What's happening? Is the COT data going up or going down long term? Since April 25.
it's going up.
Okay, so since April 25, both on the COT data at the bottom in the red, the COT data has been going up. What's been happening to silver price?
It's going down.
Exactly. It's going down.
Price going down.
So what do we say? Although the data, the chart data tells us it's selling, what does the bigger picture say here? Like bigger picture, I'm talking what's happening in the next 3 months, 6 months, year, or 2 years. What are we talking about here? Macroeconomics. What are we saying about the silver?
It's going up.
So
It's going up.
if we buy now, we would probably have to put a stop loss all the way down here. Because the chart data is going down long term and the COT data is going up. And you can see that on a 6 months. Let's look at a 1 year. Since here, where it made like a peak high of $26 or $27 on silver, from there, it's been selling, right? Choops, like that. But what's been happening to the COT data?
Moving downwards.
It has.
Selling.
How does that look like selling?
It's moving down, isn't it?
The chart data, the price, the candlesticks are selling. But what's happening to the COT data?
Buying.
Yes,
Buying.
because COT data is different. So if we draw a box here, I don't know if I can draw a box, but let's divide this range, right? So let's divide, this is the swing high, and this is the swing low. And then in the middle is equilibrium. This is not premium and this is not discount. This is a buy program and this is a sell program. It's different to premium and discount. This is not how COT data works. When we are above 50%, we are in buy. When we are below 50%, we are in sell. This is how you do COT data. And when price is making lows in a bullish COT data, what's the COT data program in a buy model? So every low is being accumulated and they are building a long order book. Again, guys, this is not something that's happening tomorrow, next week, next month. This is something that's going to happen over the next, I don't know, 6 to 12 months or 2 years, I'm talking. They are building a long position over here. Okay, let's substantiate this claim with gold. Okay, so let's look over here, the futures commitment of traders report, and then we're going to do hey gold. Okay, get a study here, and we put up these. Hey. Commitment of traders, commercials only. Get a full chart. And then we can look also at previous history to substantiate this claim I'm making that what I'm saying is actually what's happening here. So if we look at the one here, so if you remember, this was $2,089 peak high that formed on gold, right?
Yes.
Okay, so we can just put a line chart on here because we don't really care so much about candlesticks. Okay, whether it's that high or whatever, it doesn't really matter. But over here, when price was going up, okay, what was happening to the COT data?
Going down, I think. Yes, it's going down.
So from here, like this, right? And you can see that when the COT data started going down here, right? What is happening to the price of gold? It's going up. So even though the order flow is bullish, right, on this time frame, like 4 hours, daily, whatever, what's happening in bigger picture? They're selling. They're selling into the up move. They can do that because they've got trillions of equity available to them. We can't do that because we blow accounts. We can't sell from the bottom here right up. We can't do that. They have to build in a position. This is big time frame, guys. I'm not talking tomorrow. Remember this. I'm not saying this is going to happen all the time. But what's happening here? COT data is going up and the price is going up. So it's a strong buy here. Then what happens? COT data going up, but price goes down. Okay, so they're buying over here. Price going down, COT data going up. Then what happens after that? COT data goes up, price goes up. Price goes down, COT data goes up. What's happening? What's happening? What's happening?
It's still going up.
What's happening?
It is still up.
COT data is still going up.
Upside.
It's still going up. So what are they doing while it's going up and the price is going down? What are they doing to gold?
They're selling.
Sorry?
Gold.
They're selling gold.
They're selling to buy.
Selling to buy, yes.
This is only 1 year, right? So, but it will
Yes.
make more sense if I show you this on a 3 month because you know what's happened in those 3 months. So when you look at it from a year, it might not make so much sense to you. But when you look at it from 3 months, because that's really the range that we kind of trade, we're not really position traders. If we swing trade, we're doing it, you know, intra-week, intra-month, not taking profits from a trade we took yesterday in 2 years' time. No one's got that kind of patience here, I'm sure. Maybe you, Emmanuel, I don't know. Okay, but anyway, this is what I was going to show you. So remember, we looked at the 1 year now. Now we're looking at the 3 months. So there's the high that was made over here. What's happening? COT data going down, price going up. COT data going up, but price is also going up.
That's a strong buy.
Strong buy. So from all the way down here, maybe monthly order block, weekly or whatever, I don't know, it bought. Right? But what did they do here? They sold into this up close candle, right? Or this up close move, longer term. So there'd be like a weekly or monthly order block here, right? So this was a buy into this bearish order block that they sold into the up move. Okay. Then price reacted off of the monthly or the weekly and sold off again. So they are selling while the COT data is going up. Look, it's going up, it's going up. It's still selling. It's going up, it's going up. COT data is going up. Price is still selling, right? Still going up,
Yes.
still going up, still going up. Price is still going down. And eventually price bottoms out. What are they doing though? While price was going down, what were they doing the entire time?
The second
They
position
buying. They buying into the down move over here. And they haven't stopped. Look how bullish this COT data is. They haven't stopped buying this. In this down move here. You don't get COT data less than 1 month, so you can't use 1 month. 3 months or higher for COT data. But I mean, you could do this even long term, like 5 years. Let's look at 5 years here. What do you notice here is that, like more recently, so this was 2020, prices sort of from this high here, it's gone, made a high here, higher than this high. But while it's gone there and made sort of this like peak bottom on the COT data over here, it hasn't really gone lower than there, right? While price has gone higher. So prices overall, if we were to overall look at price from 1980, what's been happening to gold? It's been going up and up and up and up and up, right? Like 5 years, 10 years, 20 years. And if we look in the short-term perspective, what's happening here? Price made a high, but the COT data isn't going lower, so they're not really selling gold. You can just do this, maybe it'll look better. If anything, they are buying it. Price goes up, there's a clear example of it, and it sells. COT data sells into the up move. Price then makes a high, and it sells off. Weekly order block, daily order block, this is what you're trading from, not daily 1 hour candlesticks and whatever. This is higher time frame. They sold into this one, and then now price is going up, price is going down. Well, COT data going up, price is going down. What does that indicate to us? That wherever liquidity would be, they will use that to take more orders because the COT data is not going down. If the COT data was going down and the price was going down, then I would say it's a strong sell. Yes, the daily's bearish, the weekly's bearish, but it's not about that, guys. I'm talking bank thinking here. If we were bankers and we were talking about what we're going to get into to invest for the next 5 years, we'd be looking to hedge into gold. That's what we would be doing. We'd be looking to buy because we've got 1,000 lots we need to put into the order. We're going to be buying 100-year lots, 100 lots there. You know, you're not going to just pump in 2 million lots in one order. Price will skyrocket. You have to build in your order without affecting price to show what you're doing. They don't want us to know what they're doing. That's the whole fallacy of the market, is that they think that we are stupid. Well, most of us are, not here at least, but you know, retail traders thinking that price is reacting off of a moving average and a trend line break, and it's got nothing to do with that. It's the banks that do everything. Okay, even something tangible like gold. Someone said to me, oh, but you know, what does ICT concepts have to do with Gold, because gold, I can put gold in my house, or I could make a vault and buy gold bars. Who sets the price of gold? Who determines its value? The banks determine what it's worth, not the person on the street that stashed a whole Fort Knox at his house. It's got nothing. If the price went to zero, then that guy's got worthless gold sitting in his house. Not that it would, but they're the ones who set price.
Yes.
So when we think of it like this is something that is long-term bullish on gold. And if you were to buy gold, you can't just buy in the downtrend because it's bearish. That would be ridiculous. You'd sit through all the drawdown, possibly blow your account. So you'd have to be waiting for a weekly order block at least, at the minimum, or a weekly expansion, and then take a trade to have a long-term buy on gold. You cannot, you're not a banker, so you can't buy into a down move unless you just, swing trading for next week kind of thing, maybe. But long term, this is position trading now. Okay, then it doesn't probably appeal to most of us here, but I just, some of us do find interest in it, and it's good to understand the whole economics perspective of what's happening in price, not just, Asian session and a London turtle soup kind of thing, but macroeconomically speaking, what's happening in the world. And if you understand things like this, then wars and news has no relevance on what's actually happening. It's just a little brief moment in time for a little turtle soup of a couple of sell side or buy side liquidities. That little notion that the NFP news is going to tell us what's going to happen on the dollar index is garbage. Those numbers mean nothing, absolutely nothing. It creates volatility in that moment, or that hour, or that 4-hour candle, but it's got no effect on where the orders of price are. That's just manipulation. That's the prime time for it. Think of it like this. It's like a festival for a bank to come and grab everyone's liquidity, because so many people are trying to trade news and there's so much liquidity. It's like a festival for a bank to come in and just scoop up everyone's liquidity. It's got nothing to do with the numbers. Okay, but yeah, anyway, I'm going on now about nothing, but you guys must come and practice this if it's something that interests you, and you'd have to formulate some questions, but definitely go and check out ICT's. He's got like a whole month dedicated just to, higher time frame bonds and stocks and commitment of traders and seasonal tendency. I think it's like month 6 or something like that. So, if that's something that interests you, then definitely go through it. But I'm not that way inclined. I'm more of a short-term trader. So I used to trade like this, but for me, I'm more of an impatient person, and I want to see like profits today, tomorrow kind of thing. So for me to take an entry to, earn $500 in 3 months, I'd rather take one trade and earn $500 right now. That's the way I think. So there's more velocity in the money growth. So, but not everyone can be a short-term trader because we all live different lives. So, it's up to everyone individually to decide, what type of trader they want to be. I'd say longer term trading is easier to do when you are working and having a day job and then transitioning into that. But anyway, cheers guys. I have to go now. Good luck, good trading. Have a good weekend, and I'll see you soon.
Thank you very much. Have a good weekend, and your flu too. I hope it will be okay. Take care of yourself.
Thanks, man. Cheers, guys. Keep well.